missed the mark. So TCS was a miss on revenues and margins, but Infosys was a howler. It was a shocker. It was a big miss on both revenues and margins. Let's run you through the key numbers this time. Now, on the top line, the constant currency revenue growth, the number to focus on is minus 3.2% by Infosys. There was no estimate on the street which expected a big decline of more than 3%. TCS also missed the mark, just a 0.6% growth, but at least they managed to clock in a bit of a modest growth. Infosys' decline of minus 3.2% is the worst that I've seen at least in 10 years. And even in COVID, post-COVID, there were 2 quarters where Infosys revenues had declined. But even at that time, the revenue decline in Infosys was not this significant. Margin performance too, for both Infi and TCS was a miss. For TCS, margins were flat. The hope was for margin expansion. For Infosys, the hope was margins will be flat, but they actually declined by 50 basis points. Now let's move on to the outlook, the FY24 guidance by Infosys. There are just 2 IT companies who give you a numerical guidance. One is Infi and the other one is HCL Tech, which is why we look at Infosys guidance so closely. 4 to 7%. And look at the big come-off compared to the kind of growth it's clocked in FY23. Margins of 20 to 22% versus 21%. Both these parameters have come in lower than expectations. Remember that last year, that's FY23, the companies footed a very large wage bill on account of bonuses, the war for talent, the need to hire premium subcontracting costs, greater subcontracting costs and premium laterals, as a result of which the cost had ballooned. The expectation was that next year, FY24, the supply side situation will start easing because companies have stopped hiring. In the case of Infosys, their headcount has actually come down. Attrition is easing. So therefore, margins should have improved. But going by the guidance, it doesn't look like margins are improving. Now, let's tell you what went wrong this time. In the case of TCS's North America business, the management clearly said that at the beginning of the quarter, we were anticipating North America to grow. But North America declined by 0.8% on a quarter-on-quarter basis. Discretionary spends were put on hold. In the case of Infosys, the company said that it was not just BFSI. They saw unplanned project ramp downs in other verticals as well. So the problem isn't just with BFSI. They saw it in the case of telco, high-tech, retail. In particular, in mortgages, they also saw it in asset management, investment banking. They spoke about project cancellations as well and some client-specific issues. And the management also went on to say that while they've seen some stabilization in the environment in the month of March, it's still very uncertain. The hiring numbers also give you an indication of the demand trends. In the case of Infosys, the headcount has actually fallen by 3,600 on a quarter-on-quarter basis, while attrition, that's the silver lining. There are 2 silver linings. Attrition is falling, and the other one is the order book number, and attrition has come down. A quick word on the valuations as well as where the stocks and how they've currently positioned. Well, between the two, Infi has actually underperformed the Nifty IT index, and TCS is down 8%, but it's still trading at a valuation of 21 times. So the question right now is that if IT companies are growing at 4 to 7%, which is what the Infosys guidance is, and if margins are not really expanding because there is no operating leverage without very strong growth, what is the kind of valuation multiple we need to ascribe to IT companies? Mihir, that's the question, right? We keep saying that IT companies have fallen